Welcome to the Daily Update, where I'll go over the action in the market for Thursday, July 20th, and then we'll see how things look for Friday, July 21st. We ended up having a down day. So far, it looks like a pullback. We've been able to work off a bit of this overbought condition that we're in, maybe bring back a little bit of reality to the market overall. It just seemed like we were going up and up and up. We're still positive overall. Now we have to keep watching things. If we start to fall further, if we start to break support, if our indicators start to switch over more negative, we will have to take notice of that. But as of right now, it just looks like we're falling back from an extreme positive position, and the underlying strength of the market is still there. So let's go back and talk about what happened. Right at the open, we had a lower open. Prices fell down below S1 at 45.56, and we also fell down below S2 at 45.46. As the day went on, prices did rebound and got slightly above S1 before falling back down to S2. There was some late day selling that took prices down below S2, but it never got all the way down to S3, and we closed near the low for the day. We were down 0.68% on above average volume, so that's another encouraging sign. Volume is likely to be high on Friday as well because it's options expiration. The technicals were still positive in the background, working off this overbought condition. Because the market is really fixated on inflation and interest rates, so far the rosy scenario continues that things are going to look better down the road, but that could change at any time. What are some comments that we can make? We're still wondering, is this convergence of negative signals leading to a short-term pullback? Right now, we would have to answer yes. We want to see, where do we go from here? Are we going to pull back even more and turn more negative? Are we going to chop sideways? Are we going to see a day or two of some advances? We'll just have to play that out as it goes. The broad market held up better than the mega cap stocks. Those stocks have been on a real tear. They have some really good profits, so people were starting to sell them to lock in those profits. The Dow was up on strong earnings news, so that's a bit of a positive thing that happened. And this positive scenario continues, that will likely go into a soft landing. That means we see economic slowdown without going into a recession, that the Fed is almost done raising interest rates, and that even looking forward, earnings growth should still be there. On a short-term basis, we've lessened the number of things on our list that are short-term overbought. We still have the moving average study, the CMB composite, the CCI 20, the standard deviations chart, and the stochastics. On an intermediate term basis, things that are still overbought are the PMO studies. We're keeping an eye on our oscillators. They are showing more improvement with the ones that we look at. We're really focusing on the negative divergence with the NASDAQ 100, the Sean Trend Meter, and the BPI for both the S&P and the NASDAQ 100. Long term, we're still looking a little toppy there with our moving average study. The dollar advanced and interest rates were also up. All of the yield curves that we follow still remain inverted. Sentiment is still extreme positive at 80. It was unchanged where it had been at 80. Our trend is positive, but now the green line's coming down, so it is declining. But the ADX is still above its moving average, and both of them are above 20. So we're still in a trending environment. We default to the positive, but be aware that the green line is coming down. For right now, I'm still keeping our bias at positive. Now, yes, we had a down day. It's kind of, where do we go from here? Are we going to see some kind of a bounce back up, or what's going to happen on this options expiration Friday? And I'm keeping our momentum at positive for right now. The economic reports that came out, we had the Philadelphia Fed Index. It was down 13.5. They expected it to come in at -9. Last time it came in -13.7. Weekly jobless claims were weaker than expected. They had 228,000. They expected 240,000. Continuing claims did go up a bit, and I have charts to show both of these things to you. We're up at 1.754 million. Existing home sales did decline, down 3.3% month over month. On an annual basis, that's 4.16 million, less than the 4.25 million they had expected. Last time it came in at 4.30 million. Sales were down 18.9% if you look back a year ago. And our leading indicators, this is one that's kind of important now. It came in down 0.7%, more than the 0.6% they had expected. Last time it did come in down 0.6%. Looking at some charts, here is the Philadelphia Fed Manufacturing Index where it's been declining overall. It bounced back up a little bit, and it is just showing a little bit of recovery, but it's still below zero. Looking at the leading economic index, or the LEI, that is the gray line here, where it ticked back up just slightly on a year-over-year basis, and we compare that to the year-over-year change on GDP, which is also showing a little bit of improvement. So we're above zero and going back up, but it's still not suggesting a lot of strength going forward. The weekly jobless claims did decline. That suggests that the employment situation is still really strong because fewer people are asking for unemployment for the first time. The 4-week moving average also continues to decline. We're seeing a little bit of a tick up in our continuing claims where we're coming back above the moving average. Here's a chart showing all three of these together. The red line are initial claims where they're declining. The blue line are continuing jobless claims, which ticked back up slightly. It's kind of hard to see. And then we did get the unemployment rate not so long ago where it continues to be very low. We're also keeping an eye on the economic surprise index. The red line is the S&P minus its 200-day moving average, just to give us some kind of a benchmark to work from. The blue line is the economic surprise index, and it's above zero and going up and coming down just a little bit, meaning that when these reports come out, they tend to be more stronger than expected. Looking at some IsabelNet.com blog charts, the first one just shows the consensus earnings per share has stabilized with seasonality suggesting limited downside from here. This can always change. The line that we're paying most attention to is the dark blue line. How, yes, we've been declining with the earnings per share, and now that we're down in this area, maybe it has stabilized a little bit. We can look at the light blue line, which is the historical average, and we are below that because we've been going through a difficult time. And then they also take out COVID, the great financial crisis, and Y2K to get the yellow line. And then what they're projecting out for 2024 is also declining, but still just a little bit below the average. Treasury yields. This is what Goldman Sachs thinks will happen. We're going to go up to 3.9%, and then in 2024, we'll come down to 3.75%. A little bit more to the upside than what the futures market is currently predicting. We also look at the VIX versus the S&P. We have our own charts that we look at. This is just putting some other annotations on the chart where it continues to decline. Now, this doesn't take Thursday's action into account. This chart came out based on Wednesday's data, but it's just showing that fear is very, very low, and it still continues to be that way. 8-day win streaks tend to happen in bull markets. All of these green boxes here just show when we've had signal dates, and it typically is positive looking forward. Now, this applies to the Dow. Those that are saying that they're overweight in bonds, it's still continuing to decline. We look at those that are overweight in stocks, it's continuing to advance. Then we're looking at the latest reading from the GDP Now. I'll cover this again in the weekly video, where we're up over 2% as far as the estimate. And when they look at the economists, the top 10 are up around 2%. The bottom 10 are at about maybe 0.75% or so, but they're all predicting positive GDP. We also look at the privately owned housing units that are authorized in permit issuing places. This is starting to widen out just a little bit, but it is bouncing up. What we've seen in the past, when this tops out and starts to go down, you can see these gray areas, then we tend to go into a recession. We have been going down, and we're starting to come back up a little bit. Is that going to lead us into a recession based on this chart? Looking at our analysis and charts, here's the intraday chart where we did have a lower open. We came down to S1, tried to bounce back up a little bit, and then eventually came down to S2, dropped below that, bounced back up above S1, came back down to S2, danced along there for a while, and then broke a little lower later in the day. We didn't make it quite down to S3, and we saw a little bit of buying going into the close. Here's our intraday chart, where we were pretty negative in the initial overnight session. We turned back more positive, but we were still negative in the pre-market session. We saw most of the weakness during the cash session, and then we're drifting more or less sideways in the initial overnight session for Friday. Growth versus value. Growth really is underperforming value right now. They were both down, but growth was down even more. Where we can see on a closing basis, growth was down more than value for the large caps. It was down less for the mid caps, but it was down more for the small caps. And then our intraday chart, also not looking really encouraging at this point. The growth to value ratio for the SPY shows that we were down and closed almost near the low. Sentiment. Our Ulcer Index not really moving all that much right now, still suggesting that there's not a lot of fear. We ticked up a bit with the VIX, which is not surprising. We usually go up on a down day. We also went up a little bit on the bar chart. Volatility picked up just a little bit, but we're right around the moving averages with both of these, showing the volatility is about average right now. We're keeping an eye on the VIX to S&P 500 correlation. We spiked up and we're starting to come down. That's one of the trigger points that we're looking for of a possible pullback, and so far that seems to be playing out. We also look at the MOVE index. Bonds were down, so the MOVE index ended up going up. Stocks were also down, so we saw a little bit of an increase with the VIX, but the relationship between the two still remains very strong. The equity put call ratio, this is further in the background. This is looking positive as we see this decline. We had the latest reading of the American Association of Individual Investors. Remember, this is from a week ago, and we were going to the moon at that time, so they're now starting to get extreme positive. They could still go higher than this, but usually we want to do the opposite of what these folks are doing when it gets to an extreme positive reading. We also have the Investors Intelligence Survey, where as of the 18th, we're starting to get a little extreme, but we could still go up higher than this. I wanted to show the equity put call ratio, number one, because it finally updated, but just to show you on the daily chart how we did see an increase in this chart. When we look at the 5-day moving average, and I've lengthened this out a little bit and I've added some lines. This is what I was talking about yesterday. When we go below 0.55, and I marked other times over the last year to year and a half where we did that, a lot of times that would end up marking a top in the market, or at least some kind of a pullback. We hit this one right on back in August. We came down here in 2023, we had an extreme reading, another extreme reading, and it did produce some pullback, but then we've been seeing some strength. What we're trying to figure out right now is, have we hit a bottom and will we start to go back up with this ratio? Then looking at the longer term version of this same chart where we are below 0.55 and we came back up slightly. Looking at the other fear gauge that we look at, it ticked up a little bit, but still overall it has been declining. The same thing is true with this other fear gauge where overall it continues to decline. We saw a little bit of a tick down with the risk on risk off ratio that we see, but overall folks are still favoring a risk on position. Our advanced decline line, we actually saw an advance based on price. That's rather encouraging. A little bit of a turn down based on volume. The new highs, new lows, we're turning up just a little bit with our 5 period, and we're going up again with our 10 period. Even with the down day, we're still seeing new highs much more healthy than new lows. The advanced decline ratio ticked up a little bit and is above 0, so that's positive. The accumulation distribution, we did decline, but we still remain above the rising moving average. Saw a little bit of weakness with the cumulative NYSE advanced decline line, but it is showing some improvement in breaking out from this recent high. We turned down just a little bit with our regular advanced decline line, but still remain above these previous highs. Looking at the other NYSE advanced decline line, we're going up and we're still above this trend line. Looking at the common stock based on price, a little bit of a weakness, but still hanging in there. Turned down just a little bit based on volume, but overall this is showing some improvement. That's the positive side. The negative side is we're seeing a little bit of a breakout based on price, but it's lagging based on volume. With our advanced decline line studies, rolled over a little bit with the NYSE. We still went up with the S&P, rolled over a little bit with the mid caps and the small caps. Looking at our trend, this is where we're keeping an eye on, especially the short term. The green line is still on top, but it's coming down and it's still above 40. The ADX is still above its moving average. This suggests that we're still in a strong trend, and that trend is positive. If we see the green line continue to come down or the ADX drop below its moving average, then we'll change our stance. Here's the short-term version. We're rolling down with the green line. The ADX is rolling over a bit, but it's still above its moving average, also suggesting that we're in a solid uptrend, but we are working off this overbought condition. If we see a lot more weakness, then we'll reevaluate things. Volume has been picking up a little bit, so we're seeing some improvement there. Our short-term chart, it did look like we came up to the underside of this trend line before we started to come back down. We did close down below this pivot level. That's slightly negative. We're on the bottom now. You can see for the last 3 days, we have been above average with volume. We're still hanging in there okay with the double and triple exponential moving averages. We fell down a little bit. We'll see if that still continues. The 20-period exponential moving average is still extreme positive. We're also extreme with the 50, and we're still showing improvement with the 200. The Stochc RSI is no longer extreme positive. We have now dropped. The Williams %R is the same, where we've dropped from that extreme positive level. The CCI 14 has now dropped, but the CCI 20 is still extreme positive. Our stochastics turning down in the short term, but still slightly extreme, rolling over in the intermediate term, but still extreme, rolling over a bit with the long term, but still extreme there. The force index did decline, but is still above zero. Our intermediate term charts showing a real decrease in the balance of power. It's no longer extreme positive. The CMB composite ticked down a little bit, but is still extreme positive. We're still above the 50-period double and triple exponential moving averages. We're wondering if this will provide support. If we fall through that, will the double exponential moving average provide support like it did in the past? Our go-no-go system still remains positive with the darker blue bars. We've dropped a little bit from the highest high value, but we're not even back down to the midpoint yet, so this is still holding up. The TTM squeeze continues to show improvement with the darker colored blue bars. We're coming down. We're right on the verge of the second to third standard deviation now, showing that we're working off this extreme positive reading. The rate of change is no longer extreme positive. We're dropping below this line. The PPO studies, they still remain positive across the board. Our Arun indicator did drop, showing a little bit of a decrease in the buyers and an increase in the sellers. So we've pretty much have worked off this overbought condition. We saw a little bit of a tick down in the McClellan oscillator based on the S&P 500, but we're still positive because we're above zero. So the summation index based on price continues to advance. We're lagging a little bit based on volume, but it continues to advance. The NYSE McClellan oscillator also ticked down, but is still above zero. So when we look at the NYSE summation index, we're still advancing based on price as well as volume. The Swenlin trading oscillator, here we go again. This is the third day we're seeing a decline based on price and volume, and that fed into Thursday's action. We'll see, is that going to feed into Friday's action? However, the indicators are still positive overall because they're above zero. The PMO continues to show that we're going up, and also based on price and volume. We're seeing a little bit of a drop-off with the percent of PMOs that are rising. We pretty much have flattened to slightly decline with the buy signals, but we still continue to show improvement with the PMOs that are above zero, and that's looking extreme positive. The Elder Impulse system for the S&P has now switched to neutral with a blue bar. The parabolic SAR is still positive with the dots underneath. The slope continues to be positive, and we're also looking at the boom indicator where we came back down from an extreme positive reading on the 20 period. That's how far away are we from the 20 period moving average. We were getting quite far away, and now we're starting to come back slightly. We're seeing that same thing with the 50. It's also coming back down from an extreme reading. The MACD also continues to be positive, even though it rolled over slightly. So when we look at our oscillators all together, we're still looking positive across the board in the short and intermediate term. We're turning up just a little bit with the tricks, and we're still pretty much flat with the KST, which are our longer term oscillators. The Sean trend meter continues to be extreme positive. We're also showing an extreme positive reading with the BPI. On the positive side, that shows good momentum. On the negative side, we're starting to get extreme. The NYSE bullish percent index continues to advance. That's positive. The Chaikin money flow also is holding up again for a second day in a row after we saw that really drop off, so that's positive. This tries to measure what is the smart money doing. The Chaikin oscillator, though, still continues to decline, but it's above zero, so it's positive. The money flow has turned down, but is above 50. That's positive. Ultimate oscillator also declined, but is still above 50. The vortex turned down a bit, but the green line is still on top. That remains positive. With the RSI, we've dropped below both on the 14 period and the 9 period now. We saw a bit of a negative divergence here that we weren't getting all that excited about because we saw some really good readings after this with the RSI, but we're no longer extreme with either of these. On balance volume, it ticked down a bit, but is still positive. We saw a little bit of an advance with our S&P 500 200 period moving average study. That's positive. And we also saw a bit of an improvement with the 50 period moving average study. Here's another look at that same chart showing the improvement that we are seeing. The Copic curve still is generating a buy signal. I don't have any Fibonacci or line studies. We are still in no man's land. Our different charts, the Heiken Ashi looking a little more negative with like this doji looking candle right here. That's slightly negative. But the Kegi chart is still positive even though now it is pointing down. It's positive with a negative bias. However, the Renko chart still remains positive and the 3-line break is also remaining positive. Our different indexes, seeing some real improvement with the equal weight. Even though it ticked down, it's starting to come back up and perform about the same as the S&P. We saw a little bit of a decline with our average overall. That's meaning that the big stocks were weaker than the equal weight stocks. But overall, the big stocks have been the ones that have been really outperforming. We saw some improvement here with the Dow. It's now continuing to break out. We were pretty much flat with the transports. You could say these are still confirming each other. It would have been nice if the transports had gone up. On the bottom, we did see an improvement with the utilities where they have been showing some weakness lately. The transports to S&P 500 ratio did tick back up. We want to see this really going higher. That gives good support to the S&P. The transports and the Dow are performing about the same right now. Our discretionary equal weight versus our staples equal weight, we turned down with discretionary. We were up with staples. Our ratio did decline, but discretionary is still outperforming staples. The Dow was able to get above this R1 level. That is positive. The diamonds still remain positive for the Elder's Impulse system. The NASDAQ, though, it came up to this R2 level, came back down, and actually closed below R1. The NASDAQ Fibonacci lines were still above the 61.8% retracement level. We'll be watching about the 13,874 level if we continue to fall. Will that provide support and then be able to bounce back up from there if that happens? The cumulative new highs and new lows for the NASDAQ continue to show a little bit of improvement but are declining overall. On the bottom, when we take our new highs minus the new lows, we are positive but just barely so. The NASDAQ 100 also came up to this R2 level, came back down from it, also broke down below R1. If we continue to fall, we're going to come back now and retest this previous high. Will this level hold if we keep on falling, or are we going to be able to bounce up off of that? If we fall back through this level, that could be turning things more negative. The Qs for the Elder Impulse system have turned to neutral. The NASDAQ 100 BPI is now starting to roll over after giving us an extreme reading. That could be a potential negative signal as well. As I said yesterday, it was the NASDAQ 100 that really led the S&P higher. Could it be if the NASDAQ 100 starts to develop some weakness, it could also lead the S&P 500 lower? The Qs are underperforming the Dow on a daily basis, but overall the Qs have been outperforming the Dow. Their relationship is not as strong as it usually is. And this is the one that we're really focusing on right now. We were seeing a negative divergence on the NASDAQ 100. We were making a higher high based on price, but the PPO, which is one of our momentum oscillators, it was making a lower high. Now it's starting to turn over and possibly become negative. The small caps still closed above this R1 level, and we're getting really close to a golden cross with our S&P small cap index. When we look at our Russell 2000 small cap index, we came almost up to this resistance level, and now we've been falling back. We're coming off of an extreme positive reading with the RSI. The MACD still remains positive. The Elder's Impulse system for the small caps have switched to neutral with a blue bar. Small caps are starting to outperform just a little bit on a daily basis against the S&P, but overall they continue to underperform. Small cap growth versus value, we did see a decline and we're chopping sideways, although we're still in an overall uptrend. The mid caps still were able to hold on to this R1 level. If there's an area of strength right now, it appears to be the mid caps. They've been holding up the best so far. Now that could always change. But the Elder Impulse system for the mid caps has switched from positive to neutral. Mid cap growth really did take a hit right here, but overall it's been in a solid uptrend. The home builders also got hit a bit, so we saw the ETF coming down. The S&P was also down. Our ratio went down just a little bit, but the relationship between the two still remains strong. Not really seeing anything positive or negative on this chart. They really are confirming each other. The US dollar index was able to get back above 100, and we broke down below this all-time high with the FANG index. We had broken out, we came back down. So this support did not hold. Maybe it hadn't been lasting long enough yet since we just set the high the previous day. We'll have to see if we see more weakness in the FANG index. But Even though we saw a turn down when you compare the S&P to 3 to 7 year treasuries, the market is still suggesting that we will see a soft landing. And growth continues to outperform value, but it did see some weakness on Thursday. Keeping an eye on the bank sector, it had really been going up well. It was down just slightly on Thursday. Then looking at the financial sector, this is looking a little stronger. It was up on the day, not quite ready yet to give us a golden cross. The financials compared to the S&P did improve slightly. We're above the 50-period moving average, but we still remain in a downtrend when compared to the S&P. The regional banking ETF also had a good day, but is still in a downtrend when we compare it to the financial sector. Keeping an eye on bonds, we saw a tick up in interest rates and a tick down in price. We're still above the 200-day moving average. When we look at the Qs, which is the NASDAQ 100, to the TLT, which is the long-term bond ETF, we are seeing the correlation starting to improve, but they're still having a tendency to go in opposite directions. If you look in the past, they tend to move in the overall same direction with each other. We're seeing a divergence from that now. Can we go back up and get that back to give us more insight? Keeping an eye on the S&P to also the long-term bond ETF, we're seeing some improvement in the long-term relationship, also an improvement in the shorter-term relationship. The spread declined a little bit, but still continues to be very wide. We saw a little bit of a tick up in this ratio when we compare riskier bonds to more conservative bonds, but overall, folks are still favoring the riskier bonds because they bring in a higher yield. We ticked back up a little bit when we compare cash to the 3 to 7 year bond ETF. The market really wants this to go down if they feel more confident about what's going to be happening with interest rates. We just saw a recent golden cross with this ratio after we had been declining, so now we're starting to turn back up slightly. We're also keeping an eye on this 2007 level that we hit right before the great financial crisis. We're still above that. What we're going to be watching for is, are we going to see some kind of a rollover here, and then is that giving us a warning? Our long-term charts, we're still positive with the special K on the daily chart, but please be aware we're still negative on the weekly chart. Our longer-term moving averages, we're going extreme positive with the 150 and the 200-period moving averages. The rate of change going back 200 periods is still showing sustained improvement. Then we look at our weekly chart of the S&P 500. We're still above this resistance level. Are we going to be able to stay above that and then break to the upside? Or is this going to present a problem where we start to fall from this level? Looking at the NASDAQ 100, also still above this resistance line. If we continue to fall, will we end up closing the week below this level or get some strength and close it above? We look at the NASDAQ 100 to Dow ratio. It's still pretty high, even though it ticked down slightly. Other times when this happened, this was pretty negative for the market. Back in 2000, then we also saw this right in late 2021, right before the market really started to run into trouble. Our possible positive scenarios, we saw a tick down with the Qs compared to the S&P. Also discretionary tick down compared to the S&P. Large cap growth turned down when compared to large cap value. With our growth to value ratios, a decline with the large caps, mid caps, and small caps. The S&P to utilities ratio ticked down slightly, but still continues to go up overall. This often gives good support to the S&P. We're still looking positive when we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of their highs minus the lows. We are above zero. The 10-day average of the S&P 500 highs minus the lows continues to be extreme positive, so this hasn't rolled over yet. That is a positive thing in the background. We'll be watching this to see if this does start to decline. The 50-period exponential new highs minus the new lows continue to advance. Then on the next chart, the black line is the indicator that we use. The red line is what we used on the previous chart to measure this overall trend. The growth to value ratio ticked up just a little bit. We're still on a positive uptrend, but we are declining overall. This is a little bit of a concern. We want growth to be outperforming value. Our staples to S&P 500 ratio ticked up just a little bit, but still continues to decline overall. Often that gives really good support to the S&P. So what's our outlook for Friday? It is options expiration on Friday, and that's always kind of its own crazy day, and we will likely see a real pickup in volume. The rebalanced NASDAQ 100, that will start on Monday. It was based on the close a week ago. It took them a week to figure all this out, so that could change things a little bit when we open on Monday. The technicals are positive, but right now it looks like we're just working off being overbought. We won't get any economic reports in Friday's session. We're keeping an eye on all the geopolitical events. The market continues to be fixated, as it has been for over a year now, on inflation and interest rates, which is dealing with growth concerns. Here's the updated version of the economic calendar for the week. Also, we are in options expiration week, where we tend to be up 57.1% of the time. We're down 42.9% of the time. That's for the week. Then next week, we will be more 50-50. So it's a roll of the dice how things will go then. For July 21st, we are negative historically, all across the board for the Dow, S&P, and NASDAQ. We will be on the 14th trading day of the month, which will also be options expiration. After this is when we do see some seasonal weakness. Also, we're coming into that seasonal weakness when we're looking at the NASDAQ itself. So our scenarios, we're not going with the down one yet. We're still positive overall. And right now, it just looks like we're working off this overbought condition. We can still go with the positive scenario, but unless we have an update, you probably don't want to go against that in case there's more working off to do. And we're not going with the sideways trend because both the ADX and its moving average are above 20, suggesting that we are in a trending environment. The warning signs. It does look like we're seeing a convergence of these short-term bearish signals. They came into play in Thursday's session. The S&P to VIX ratio, the 5-period moving average of the equity put call ratio, the negative divergences, specifically in the NASDAQ 100, and we're coming into some weak seasonality right now for the month of July. Our longer-term trend signals may be signaling a top. We don't really know that. We're not going to know until after Friday's close because that's a weekly chart. We are coming into a weaker period of the month. The oscillators are negatively diverging, even though they are improving. Again, the one that we're focused on right now is the NASDAQ 100. The VIX is still showing that there's not a lot of fear in the market. The cumulative new highs and new lows for the NASDAQ continue to show weakness, even though they've spent the last couple of days turning up slightly. The 3-month yield, where we were back in 2007, it's at that same level before we went into the great financial crisis. And the S&P growth is weakening even though it's still in an uptrend. And then we're dealing with earnings season, which can be positive or negative. Our positive signs in the background that I usually go through in the weekly video, we still have positive seasonality and setups. The long-term special K daily chart is positive, but be aware the weekly chart is negative. The longer-term equity put call ratio is positive. The S&P remains above the downtrend channel upper line. We're still far away from that. We're still in a risk-on posture, which is positive. Lower price levels may provide support. So far, it looks like that's been holding up. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're continuing their breakout. They're above overhead resistance. Can they stay above that, even though we've seen some pullbacks now? The staples to S&P 500 ratio is declining, which gives good support to the S&P. The Russell Index and the mid-caps have generated recent golden crosses. We're getting close, but we're not quite there yet with the S&P small cap index. Small and mid-cap growth continue to be positive, even though both of them took a hit on Thursday, and the Copic curve has generated a recent buy signal. So our conclusion, the S&P remains positive for right now, and we're just working off this overbought condition. We can say that in the short term as well as the intermediate term, and we're still positive in the long term. Thank you. I hope you found this helpful. Have a great day, and I will talk to you in the next video.